EFPs are gaining increasing relevance among foreign exchange market participants. Technically, an EFP is the simultaneous transaction of an over-the-counter FX instrument and an exchange-traded FX future. Both legs of the trade are in the same currency pair, but in opposite directions. They are traded bilaterally between clients and their banks in one single transaction, for example, sell FX spot and buy the FX future. And while the OTC leg of the EFP remains bilateral, the futures leg is registered with and centrally cleared by Eurex.
This means EFPs are bilateral transactions between a client and their bank. They're a product which allows a client to do a trade away from the order book via voice or chat, or for EFPs on Eurex, clients can also use 360T to put their providers in competition electronically and to manage their EFP workflows across all of their trading counterparts.
With EFPs, participants can efficiently transfer a position between OTC and listed FX futures markets. A client with a FX spot position resulting from a trade with OTC counterparts may wish to swap that exposure into a future. For this purpose, they can enter into an EFP with their bank to sell the spot and buy the future. After the EFP has been completed, the two spot legs can be netted. And as a result, the client has successfully converted their spot into a futures position.
EFPs are a pretty straightforward transaction from the exchange perspective, but they allow multiple use cases, each exploiting the EFP's ability to combine highly liquid OTC FX markets with the advantages of standardized and centrally cleared FX futures. This, of course, also helps optimize portfolios from a capital, credit, and uncleared margin rules perspective.
Eurex has established EFPs as a common functionality across asset classes. The initial purpose of an EFP was to exchange an OTC position for an equivalent futures contract.
An increasingly common EFP case is where a client doesn't have an OTC position to translate, they just want a futures position as a result, but they're mandated to execute using an OTC benchmark such as the London 4pm fix. Bank and client agree the basis for an EFP to do this, where that basis is the charge covering the forward points plus any fee for clearing in this way. Then once instructed, the bank builds the OTC position at that target rate, typically into a client account that doesn't immediately generate settlement instructions, then uses an EFP to buy back that position from the client to net out any OTC settlement and simultaneously sell them the futures position. With the futures price for this being the achieved OTC rate plus the basis charge previously agreed by client to clear this, the client gets their futures position essentially by clearing their OTC execution at their target rate. Let me give you another example of how this is used. So the client wishing to roll their month-end September OTC FX position to December, who still wants to use the deep FX swap liquidity pool, will request their swap with their bank basket and indicate they want the December position to be futures, just because they believe this will achieve their best execution rate. Then the winning bank in that situation will receive and process and price the client swap using normal processes, executing the OTC swap into a client account. Then as a distinct clearing bolt-on, the bank books an EFP to buy back the OTC December leg into their own book and simultaneously sell December futures to the client. So the clients rolled their September OTC position into December futures using a cleared by EFP FX swap liquidity pool. There are several variations on this. We have EFPs in 360T to transform OTC into futures or back from futures into OTC, and we'll continue to build out the functionality as this evolves. This may be where both legs of the swap are already futures, or there may be a non-standard value date that requires flex futures, so that's flexible futures where users can create their own maturity dates instead of IMM dates, international money market dates, or variations even more complex than that. The point is the EFP transaction itself is quite simple. Two legs, sell one by the other. It's the potential activity preceding the EFP registration that's driving development through the market.
The EFP functionality has significantly evolved in FX markets over time, from a tool to move positions between OTC and listed markets to a fully fledged functionality that replaces clearing workflows and that offers OTC liquidity in FX futures markets. Clients and banks alike are therefore increasingly relying on EFPs as a tool to optimize their FX portfolios. Clients can utilize EFPs to replicate their OTC trading capabilities when trading FX futures. And they are therefore increasingly relying on EFPs when moving from uncleared to cleared FX products.